Buying a stock, a commodity, or even a crypto asset, it's frankly the easy part, right? You do your research, you hit a button, and boom, you're in. But knowing exactly when to take your money off the table, man, that is the ultimate investor dilemma. Welcome to This Explainer. Today, we are tackling what is arguably the most difficult, emotionally charged decision in trading and investing, exactly when and how to sell. Because here is a pretty stark reality we all have to face. Until you actually hit that sell button, your gains, they're just numbers on a screen. They are literally just paper profits. And that means they are entirely vulnerable to market whims, sudden news drops, or massive economic shifts. Without a clear, ruthless strategy for realizing those gains, you aren't actually securing wealth. You're really just riding a roller coaster. Okay, so let's dive into this. Consider This Explainer your definitive guide to moving away from that emotional, panicked guessing game and stepping into a world of systematic execution. We're going to look at some core profit-booking strategies, heavily inspired by financial educator Shankar Nass, along with some incredible automated tools that can take the heavy lifting completely out of the process. We're building a strategic toolkit so you know exactly how to manage your positions like a pro. So here's our roadmap for today. We're going to start with mindset and valuations, then move right into tactical execution, discuss your post-sales strategy, and finally wrap up with the cutting edge of automated profit booking. Let's get to it. Section 1, Mindset and Valuations. This is all about building the right foundation before you even think about selling. Let's start with a trap that catches almost everyone, honestly. It's the massive difference between having an emotional reaction versus following a logical process. The emotional trap, that's staring at your percentage gains. You see a stock is up 40% and your brain just starts screaming, sell before it drops. Or maybe it's down 20% and you totally panic. But here's the thing. Percentage gains tell you absolutely nothing about the underlying asset's future. Nothing. The logical framework requires you to analyze valuations. Ask yourself, is the asset actually expensive right now compared to its true underlying worth, its intrinsic value? Or has the market simply finally realized the value you saw early on? You've got to decouple your brain from the percentage return and attach it strictly to the valuation. So what it really comes down to is conviction. Conviction has to be your absolute anchor here. It's your level of confidence in an asset's future performance based on that deep underlying research and valuation we just talked about. If your conviction is still sky high because, hey, the company's fundamentals are crushing it, you don't sell just because you're up 50%. You hold. Conversely, if your conviction is completely broken because your original thesis is no longer true, well, you fold, even if you are down. It's your conviction level, not your fear of losing a paper profit, that must dictate the trade. Moving right along to Section 2, Tactical Execution, the actual mechanics of making the sale. All right, here is our master list of execution tactics. When it's finally time to take action, you basically have a few distinct paths: the all-or-nothing approach, selling in smaller chunks, and a super vital maintenance step we like to call cleaning up the mess. Let's break these down so you can see exactly how to take money off the table. First up, the all-or-nothing exit. You just drop the whole boulder at once. And sure, it feels decisive, but let's be real. It often leads to deep, deep regret when the asset just keeps climbing without you. On the flip side, we have scaling out. This is taking profits in smaller chunks, kind of like walking up a staircase. Let's actually apply this to highly volatile markets, like Bitcoin or gold. Instead of trying to guess the absolute top, which is impossible, you use a step-by-step setup. Step 1, you take a partial profit when the price hits your first target. Maybe that's a key resistance level, or what traders call a 1R target, which just means you've made back your initial risk. Boom, you lock that first treasure chest in. Instantly, your emotional pressure just vanishes. Step 2, you move your stop loss right up to break even. Now, you've got a totally risk-free trade. Then you just let the remaining position run up the rest of the stairs toward the next major target, like a big liquidity zone where a lot of trading activity is expected. Your final exit only happens when there is a clear structure break or a legit reversal signal on the chart. I can't stress enough how much this strategy improves your overall equity curve compared to just dumping everything early or holding way too long. It beautifully balances greed with discipline. You protect your capital, you completely avoid the regret of closing a full position too early, and you stay patient with your runners. It's a total game changer. But listen, tactical execution requires intense discipline in other areas too. You absolutely must clean up the mess.
Look, it's human nature to want to cash in on our winners, so we feel smart, right? While at the same time, we completely ignore our losing positions just to avoid the psychological pain of admitting we were wrong. But proper execution means cutting those losers. If your conviction is gone, get your capital out of there. You have to prune the weeds from your portfolio, not just cut the blooming flowers.
Okay, Section 3, post-sale strategy. The classic, I sold, now what? You see, the sale is not the end of the transaction. It is really just the midpoint of your capital's flow. Obviously, step 1 is booking the profit, but step 2 is vital. You must have a redeployment plan. Cash just sitting idle in an inflationary environment is like a leaking bucket. Before you even click sell, you should already know exactly where that capital is going next. Is it going into a safe haven asset, maybe a new high conviction stock? And step 3 is rebalancing your overall portfolio. Say a massive tech run-up means your portfolio is suddenly 80% tech. Taking profits allows you to rebalance your risk profile right back to your target allocation. Finally, let's hit Section 4, automated profit booking. This is all about taking human emotion completely out of the equation. Let's look at how this builds into modern algorithmic trading. Platforms like Tritron actually allow you to set up what's called a range breakout strategy. Basically, this is an algorithmic setup that systematically identifies exactly when a price breaks out of a defined consolidation range. And the beauty here, you pre-program the machine to capture that momentum without you having to sit there staring at the screen, constantly battling your own psychology. The benefits of this kind of automation are just massive. The algorithm automatically handles that partial profit booking we talked about earlier. It programmatically locks in your gains at predefined levels along the way, while letting the remaining positions ride the trend. By doing this, it optimizes your risk management and your returns dynamically. You never close a full position too early or too late, simply because the math is executing the discipline that our human brains naturally struggle with. It's brilliant. So we've walked through valuations, the mechanics of scaling out, cleaning up your portfolio, and even using algorithms to enforce your discipline. Now, I want to leave you with a quick question to evaluate your own approach to the markets. When you are staring at a massive gain on your screen, what is your default reflex? Do you prefer the decisive all-or-nothing exit? Or have you mastered the art of scaling out with partial profit booking to let those winners run? Think about how you secure your wealth and see where you can optimize your own strategy. Thanks for joining me on this explainer. I'll catch you next time.